Let me quickly talk to you about the top 5 biggest tax credits you might qualify for this year. Welcome back, folks, to another edition of the Awesome Sweaty Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka. Now let's roll. In today's conversation, I want to share with you the top 5 biggest tax credits you might qualify for this year. But before I get into the nitty-gritty, please let me first give you a short overview of what we talk about when we speak about federal tax credit. It's important because a lot of folks have some kind of confusion when it comes to the matter. So federal tax credits can be a big help to low to moderate income taxpayers looking to reduce their taxes or maximize their tax refund. Okay, it's important. Now, how does a tax credit work? A tax credit is a dollar-for-dollar reduction of the income tax that you owe. For example, if you owe $1,000 in federal taxes but are eligible for a $1,000 tax credit, your net liability drops to zero. Some credits, such as the Earned Income Credit, are refundable, which means that you will receive the full amount of the credit even when the credit exceeds your entire tax bill. Therefore, if your total tax is, say, $400 and you claim a $1,000 earned income credit, you will, in this case, receive a $600 refund. So this is really important to understand that. And there are different types of tax credits. So there is a constellation of tax credits available to all types of taxpayers, covering a wide range of expenses and situations. So the thing here is that the federal government does have incentives for taxpayers to protect them from the environment, for example, to take care of their children, okay, to make sure that they actually reduce their tax liabilities. And so if you want to compare credits to deductions, there is a big difference. Okay, so basically deductions only reduce the amount of your income that is subject to tax, whereas credits directly reduce your total tax. I've just said that, dollar for dollar. Okay, and you also have to think about your state tax credits. So basically, many states that impose an income tax on residents oftentimes offer tax credits. For example, if you live in California, you may qualify for a renter's credit. If you pay rent for your housing, your income is kind of low or below a certain amount, and you meet other states' requirements. Very important. And many states also offer tax credits similar to the federal credit. So this is kind of important to have a clear idea about that. So this is a foundation I want you to understand before we talk about the tax credit that you might qualify for this year. So the top 5 tax credits you might qualify for. Number 1, Earned Income Tax Credit. So one of the most substantial credits for taxpayers is the Earned Income Tax Credit. So this was established back in 1975. And basically, this is the EITC is determined by income and is phased in accordance to your filing status. So whether you're single, married, filing jointly, or either of those with children. So eligibility and the amount of the credit are based on adjusted gross income, earned income, and investment income. Okay, so the thing here is that there are some thresholds, whether you are filing jointly, whether you are filing single, or married, filing with children. It's important. So if you may be claimed as a dependent on another filer's tax return, you do not qualify. Okay, so you do not qualify for this earned income tax credit if you can be claimed as a dependent on somebody else's tax return. So let's spill more beans. So the thing here is that the Earned Income Tax Credit is a refundable tax credit for low and moderate income workers. It's very important to mention that because we're speaking here about income thresholds, okay? And you have to understand that Earned Income Tax Credit works in a very simple way. Basically, your income has to be between $1,500 and $6,500 depending on your filing status, the amounts actually vary every year. But yeah, you are having a ballpark here, and it depends on the income you earn, but also how many children you have. Okay, so you don't have to have a child in order to claim the earned income credit. However, the amount you might get could be lower. Very important. And one thing I want to say here is that so if you want to qualify for the earned income tax credit, you must have at least $1 of earned income. Pensions and unemployment do not count. Your investment income must be less than $10,000. Okay, and the thing here is that you must not have to file Form 2555 foreign earned income or Form 2555 easy foreign earned income exclusion. Okay, so this is really important. And so the child that you can actually claim can be your son, daughter, adopted child, stepchild, foster child, or grandchild. Not a problem. Okay, if you don't have kids, you must have resided in the United States for more than half a year. Okay, no one can claim you as a dependent or qualifying child on their tax return. This is really important. And if you make errors, remember, if you make errors, the IRS is known for being very late at getting back to you. So make sure that you pay attention. And if you make errors, you might need to file Form 8862, information to claim earned income tax credit after disallowance, before you can claim the EIC again. So be very careful here. Tax credit number 2, we have the American Opportunity Tax Credit. This is a very important tax credit that could reduce your tax liability a lot. So for years, the HOPE credit helped families pay the cost of a higher education. But since 2009, that credit has been rebranded and expanded as the American Opportunity Tax Credit. So the AOTC, as it's been called lately, covers 4 years of post-secondary education. So the full credit is available to people whose modified adjusted gross income is $80,000 or less, or $160,000 or less for married couples filing jointly. Jointly, I said, okay? So depending on your income, the credit drops as income increases. So you may receive up to $2,500 of the cost of qualified tuition and course materials paid during the taxable year. And the student must be enrolled at least half-time for at least one academic period. Very important. Okay, so this credit is available on a per student basis. So this is really important. So let me just spill more beans here. I really want to explain. So the AOTC is what? It is for qualified education expenses associated with the first 4 years. 4 years. Now, so if you do an MBA, you don't qualify. The 5th year does not qualify. Okay, the first 4 years of a student's post-secondary education. So the maximum annual credit is $2,500 per eligible student. And so the student can be someone, it can be your dependent, it can be a spouse making post-secondary education payments. Okay, so they can claim the AOTC, not a problem. And so it's really important to understand that if you want to claim the AOTC, you have to pay qualified education expenses for higher education. You have to pay the education expenses for an eligible student. And the eligible student can be either you, your spouse, or a dependent whom you can claim on your tax return. Okay, and so it's really important to understand you have to enroll in a normal academic program, university, college, or whatnot. Okay, and also there is some kind of distinction between the AOTC and the lifetime learning credit, because both credits are popular tax breaks. I'll speak about the lifetime learning credit next, but they are both popular tax breaks that people with educational expenses can claim on their annual tax returns. Okay, the only difference is, and I'll speak about the difference later on, with the LLC, you can claim up to 20% of the first $10,000. So you can claim only $2,000. For the AOTC, the amount goes to $2,500. But for the AOTC, you don't have to. You have to enroll in the 4 years in terms of post-secondary school, which is a little different for the LLC. I'll speak about the LLC later on. And one thing I want to say here is that let's talk about the LLC. So, lifetime learning credit. So basically, the lifetime learning credit is what is it? It is established. It is also established to offset the cost of post-secondary education. But this credit differs from the American Opportunity Tax Credit in that it is available for any years of post-secondary education not just the first four. Also, the credit is available for people not pursuing a degree. Okay, so the limit here is $2,000 per eligible student, and so this is what it is. And actually, there is a limit to the income you must make to qualify for this credit. So the full credit is available usually. For last year, the credit was available to individual taxpayers who make $80,000 or less, or married couples filing jointly who make $160,000 or less. Okay, so let's just spill more beans here. We're trying to really understand. So the lifetime learning credit, LC as it is called, it is a provision of the U.S. Federal Income Tax Code that lets parents and students lower their tax liability by up to $2,000 to help offset higher education expenses. And unfortunately, the LLC is not refundable, which means you can use the LLC to pay the taxes you owe, but you don't get a refund back of any kind, okay, according to the Internal Revenue Service. So the thing here is that the student can be enrolled in undergrad, grad, or professional degree courses, and the credit may also be used for courses in specific career-related skills. Okay, if you want to claim the LLC, you're going to have to file Form 1098-T tuition statement. So not a form, you have to get Form 1098-T from the institution where you actually paid the tuition and other fees, and you're going to have to take that form and you have to file your taxes, your 1040, around that form to actually prove to the IRS that you have indeed paid for those fees yourself. Okay, so please be on the lookout for Form 1098-T from your university, from your college, from your training institution, and whatnot. If you do not receive this form and you are about to file your tax return, please contact the institution and ask them to send you a 1098-T form ASAP. Because without that, the IRS is not going to believe that you actually paid for the fees that you are mentioning on your 1040. So be very careful about that. Credit number 4, we have here Child and Dependent Care Credit. And this is a very good credit. And the cool thing is that this credit helps defray cost of babysitting or daycare. So it is really available to people who must pay for child care for dependent under age 13 in order to work or look for work. So the credit is also available for the cost of caring for a spouse or a dependent of any age who is physically or mentally incapable of self-care. So to qualify, your filing status must be single, married filing jointly, head of household, or qualifying widow or widower without a qualifying child. Okay, so this for last year, the credit, which ranges from 20% to 35% of depending on your income, can be applied to as much as $3,000 of qualifying expenses if you pay for the care of one of your qualifying children, or up to $6,000 if you pay for the care of 2 or more. Okay, so this is kind of cool. And during COVID, the government has actually increased the amounts that you could qualify for. So that's really great. Let's build more beans. So the Child and Dependent Care Credit helps you pay for expenses that relates to child care that you need to take care of if you have to work or look for work. Okay, so there are limits, and the limits depend on your income. So the higher your income, the lower the limits. Okay, and the thing here is that the child must be under age 13. Now, if you care for an adult who is incapable of self-care, there is no age limit. This is really important. So any kind of child or dependent care can qualify, including care at a center, a family daycare home or a church, vacation day camps, or care provided by a neighbor or a relative, except if provided by a spouse, a dependent, or a child of the tax filer under age 19. Okay, and if a family receives free child care, such as from a state subsidized program, that care cannot be used to qualify for the credit. So co-payments by families for subsidized care, however, are an eligible expense. It's very important. And the EITC, so the Earned Income Tax Credit, and the CTC, the Child and Dependent Care Credit, do not affect a family's eligibility for this credit. Okay, and claiming all three credits when possible actually may mean even more money back from the IRS. So this is really important to remember that. And one thing I want to say is that if you want to claim the credit, you must file Form 2441. You must file this form and submit it, and submit all the information, and you will get the refund. Not a problem. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another session of the Awesome Sweetie Kiwi Show. We are still having a conversation today about the 5 biggest tax credits you might qualify for this year. Credit number 5, tax credit number 5, Savers Tax Credit. So the Savers Tax Credit, formerly known as the Retirement Savings Contributions Credit, is for eligible contributions to retirement plans such as qualified investment retirement accounts, 401ks, and certain other retirement plans. So taxpayers with the least income qualify for the greatest credit, up to $1,000 for those filing as single, or $2,000 if filing jointly. Okay, so last year, the maximum income for the Savers Tax Credit was $33,000 for single filers, $49,500 for heads of household, and $66,000 for those married filing jointly. And as a filer, you must be at least 18 years of age and may not have been a full-time student during the calendar year or claimed as a dependent on another person's return. Okay, so this is really what it is. And let's just spill more beans here. So this is a non-refundable tax credit. In other words, you're not receiving any money from the IRS. Okay, and so this can be claimed by taxpayers who make salary deferral contributions to their employer-sponsored 401k, 403b, simple, SAP, or governmental 457 plan, or make contributions to their traditional or Roth IRAs. So the amount of the credit varies and depends on the adjusted gross income of the taxpayer and the amount of the contribution or contributions. So very important to remember that. So basically, the Savers Tax Credit can be claimed only by those taxpayers who make contributions to certain defined contribution plans and IRAs. Very important. Okay, and the Savers Tax Credit is a non-refundable tax credit. In other words, you're not getting cash from the IRS, and it is a tax credit between 10% and 50% of the individual taxpayer's eligible contribution of up to a total of $2,000. Okay, which gives it, if you really do the math, a maximum value of $1,000. So this is really important to have, and this is a tax credit that was legislated into effect for tax years in the past, okay, but they have been reconducted. So the government has been actually pushing it back over and over the years. So this is a great tax credit that you might qualify for. Check it out. Maybe you qualify for it. Let me give you a few pro tips. So we have spoken about the 5 biggest tax credits you might qualify for. Now I want to give you a little bit of info about the 10 popular tax deductions that you might qualify for. Obviously, we have said this before, a tax deduction is actually an amount of money that reduces your income subject to taxation. That's what we call adjustable gross income, right? Resulting in a lower tax bill. So after you calculate your total gross income for the year, you can deduct certain adjustments to income, such as student loan interest payments, educator expenses, self-employed health insurance payments, certain alimony payments, contributions to our retirement accounts, right? So these adjustments to income are also known as the above-the-line tax deductions, meaning they reduce your gross income to arrive at your adjusted gross income, the figure the Internal Revenue Service generally uses to determine your eligibility for certain other tax deductions and credits. Okay, so this is really important. So when we talk about above-the-line and below-the-line deductions, AGI, adjusted gross income, is the line. Okay, so the most popular tax deduction is the standard deduction, a below-the-line lump sum amount that can be used to reduce your taxable income by a fixed amount. Most other below-the-line deductions are itemized deductions that vary from person to person, such as medical expenses, state and local taxes, mortgage interest, donations of goods to charities. Okay, so I want to share with you here the popular tax deductions to claim on your tax return this year. So the standard deduction. Number 2, the IRA contributions deduction. Number 3, the health savings accounts deduction, the HSA deduction. Number 4, state and local taxes deduction. Number 5, we have the medical expenses deduction, very important. Number 6, we have the home office deduction. Number 7, we have the student loan interest deduction. Number 8, we have the mortgage deduction. Number 9, we have the charitable contributions tax deduction. So if you make cash or non-cash donations to a 501c3 organization, your contributions may be tax deductible. Typically, you need to itemize your tax deductions to claim the charitable contribution tax deduction. Very important. And number 10, we have the educators expense deduction. So the big question is, should you itemize your deductions or just take the standard deduction? We have actually answered this question on another show. So if you are interested in the subject, just let us know. We'll give you more info about the topic. We'll even link you to that video. But the bottom line, it depends on your financial situation. All right, very important. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about the top 5 biggest tax credits you might qualify for this year. So I give you an overview of tax credit versus tax deduction. So the 5 biggest tax credits are the Earned Income Tax Credit, the American Opportunity Tax Credit, the Lifetime Learning Credit, the Child and Dependent Care Credit, and the Savers Tax Credit. And then I share with you a few pro tips to make sure that you can boost your chances of optimizing whatever tax credit you claim on your 1040. Thank you so much for your attention. I really appreciate it. I'll see you next time. But until then, remember, stay marvelous.